Hi, I'm Alan Leza, Certified Public Accountant. I'm practicing in Longview, Texas, and welcome to the second installment of Tax Tip Tuesday. If you missed the first installment, check it out on the webpage because we're going to keep all the prior series so that you can catch up on anything you might have missed. In that first installment, we sort of prefaced the 2017 Tax Cuts and Jobs Act, which actually went into effect on December 22nd of 2017. At that time, I told you that for the most part, the new tax law would be affecting and impacting personal and business tax returns for the 2018 tax year through 2025, barring any changes in legislation. What we're going to talk about today is actually one aspect of the law that was in place at the end of 17, actually retroactive to September 22nd of 2017, and that's MACRS, or what we call tax depreciation. MACRS stands for Modified Accelerated Cost Recovery System. It's a different book from book depreciation. It evolved as of the Tax Reform Act of 1986. That was actually the second of two Ronald Reagan tax packages. It allowed for the quicker recovery of the cost of assets via tax depreciation. Two big mainstreams of MACRS depreciation are bonus depreciation and Section 179. Section 179 and bonus both historically have seen different thresholds used over the last years. A new tax act has changed a lot of that. Section 179 now allows you to expense qualifying business assets up to $1 million on $2.5 million of capital acquisition costs. In essence, if you spend more than $2.5 million on qualifying assets, you wouldn't be able to 179 them. That gets phased out. Bonus depreciation has gone anywhere from 30% in 2002 to 100% and back down. It was actually being phased out. Well, the new tax law has put it back at 100% bonus depreciation, and that's going to carry us and phase down until about 2027 when it's completely gone. The big input here is that if at this year end, as we get close to December 31st, if you're really looking for a great tax savings, you want to consider acquiring assets now. It's not just a matter of putting out a bill, it's a matter of putting those assets into service. But there are some really big tax savings on the table for this year as well as the future years through 2025. There are so many different ramifications and with regards to what assets qualify, but for the most part, anything from a track coat or a tractor to a computer are going to be subject to both either 179 or bonus depreciation. The bonus depreciation is a big change in that is that in prior years, it was only for the acquisition of new assets, not new to you, but new off the lot. That's a big economic incentive in the past because they build more John Deere tractors and Kubota track hoes, putting more people to work. The change in the new tax law now has made bonus depreciation available for both new and used assets, and that's a huge change. There's also big changes with regards to Section 179 and real estate, non-residential real property. So there's just a myriad of benefits out there for both the consumer, with a small business as well as large commercial entities. That's your tax tip today. Take action on it. If you need more information, feel free to contact me. I appreciate your time. Happy holidays, Alan Leza, CPA.